Good morning all. So today we'll discuss about the fundamental analysis. Okay. So, so the conventional that fundamental analysis, I think all these faculties, they are already aware of that because the textbook and all, they are having the fundamental analysis chapter. And we know about the economic analysis, industry analysis, company analysis, that is EIC analysis, that you are already gone through. Here at the level, those who have reached, those who are faculties, they have already studied all these things. But how can we deliver the fundamental analysis in a different perspective? Or we can say how the fundamental analysis discussion we can discuss in the class with the help of live market data. Okay, because exposing to the live market, exposing the students to the live market data is very important. Okay, until unless that is done, the learning would not be complete. Conventionally, what you have seen that fundamental analysis, they do, the students generally, they do some ratio analysis and that ends there only. Okay. But actually the fundamental analysis is not about calculating some ratios only. It's more than that. So how can you use this practical data for analyzing a company? Okay. So initially our discussion will be just to begin the discussion. We'll take the help of few PPTs. Some slides will be there, 4 or 5 slides will be there. After that, we'll move into the practical calculations and the live market data. So, so what is the fundamental analysis? So we'll not spend much about on the what is fundamental analysis because I think all are you already know about it. So before investing a company, we should analyze a company. Okay. Now, analyzing a company can be done in 2 ways. One way, if I want to invest for a longer period of time, I have to understand the real business of that company or the business model of the company. Okay, is actual financial performance, how the company has performed. But if I am not too interested to stay in that company for a long period of time, if my intention is only to make some quick speculation, quick profit and get out of that, so I may not be interested in all this company performance, company's data, company's business and all. So in that case, I will depend on the price action. Okay. For that, I will take the help of different charts, different price movement or price action. So that is the technical analysis. Yesterday, in detail, it has already been done. Now our intention, if we want to stay in that company, stay invested in that company for a long period of time. Now how to analyze that company? Okay. So the fundamental analysis will start with that general economic situation. Okay. Present economic situation. So present economic status, like the current status, if we discuss. So we will keep our discussion that economic analysis in a broader sense at the last, because today it is in today's respect, this economic analysis is very vital in the sense that nowadays, in which way the market is, especially the Indian market or the third world countries, emerging economies market is performing, the challenges that we are facing, it has a definite reason and it relates to the economy. So that discussion will keep it at last. Why the market is performing last from September, October so badly? Okay, where is the problem? So we'll keep it at the last. So I'm not getting into that economic analysis right now only. But economic overall general economic status of the economy, it is very important to analyze. After that, the industry industry analysis will do also through the data only. Through the data analysis, how can I see that which industry is performing good or bad? That way we'll see. So then we'll narrow down our discussion to the particular company, that is the business model of that company. Okay, what is the revenue stream? What is the major revenue stream? And what are the business verticals? How the business verticals are contributing to the revenue? Okay, what is the major cost? Okay, so we have to understand the entire business of that company. That is business model. No, management is very important. Okay, whether the this management it is trustworthy. Okay, honesty. Okay, and what is the what we can expect from that management? What is the background of that management? That is very crucial. Okay, what is their intention actually? Okay, are they really interested to expand this business? So that we need to see. So management checking the background of that management is very vital. Okay. Next come the important ratios of the company. The student mainly they focus on this important ratios part. Their fundamental analysis is only to the ratio only done. But it is more than that. Okay. So after the ratios analysis, we have to see the company's performance, its annual performance, quarterly performance, very important for analyzing that company. Quarter to quarter performance. Okay, we'll see. And lastly, so what is the end objective of the fundamental analysis? So the end objective of the fundamental analysis is to arrive at a value. Okay, what is the value of this stock? What is the value of this business? So that is the end objective. That means when fundamental analysis is throwing up some value, that means what value the market is showing, that value is not correct. So fundamental analysis is challenging that market value. Okay. So that value actually will help you to take the investment decision, whether we should invest in that stock or not. Okay. So when we'll say the value, that means the market value, it is not correct. If we say the market value is not correct, it has got two meaning. Either it will be an undervalued company. So if my value, as per the fundamental analysis, if the value of the company, if it is coming 120 and the market price, if it is showing 90, that means we can say that company is undervalued. So we should buy. And if we find that the price is fundamentally the price, it should be the 120, but actual price is 140. That means it is overvalued. That means we need to sell that, but we should not continue with that same company. So ultimately, fundamental analysis is telling that whatever market price is showing, it is not correct value. So we are helping you to arrive at the correct value. What is this real worth? Okay. So our intention will be, our discussion will be to reach this, arriving this value only. Okay. Now, you see the many broking firms or the analyst, they throw up some target value, target price. What is the target price? Based on the target price, they actually pass their suggestion or recommendation whether to buy or sell. The target price is nothing but that value, that intrinsic value, or we can say fundamentally what should be the value. Okay. Sometimes they revise this target because after quarterly performance, each quarterly performance, whatever that expectation, if the expectation is not met, company, if it is underperformed, they have to revise that value. Say at the beginning, they have arrived the value at 120. But after the bad performance this quarter, might be the company have to revise that target price and might be reduced to 100. So that way, it is not a constant value or target price. It will be revised from time to time. Okay. Now, so this person, Mr. Warren Buffett, he has thrown a very important discussion about the value. So there are two terms in this. One term is value, another term is price. Actually, last whatever we have discussed, it is comparing the value and the price. Value is means that price we are arriving at fundamentally, and price, what is that market price. So what he told, that value what we receive and price what we pay. Okay. Price what we pay means the market price that we pay. And in return, what we are getting, the value that we are receiving. Okay. So therefore, this condition before buying anything, this condition needs to be fulfilled. So what is the condition? Condition is that the value should be greater than equals to price. So if the value is not greater than equal to price, there is no point of buying that product or service. Okay. So the example that last time that we discussed, that 120 is the value we have arrived. So if the price is 90 or 100 or below 120, then only we will be interested in buying. Otherwise, no. It will be a loss making. So if it is that means if it is an undervalued, then only we should buy it. Okay. Now the value we are discussing. So how to arrive at the value? That is $1 million question. How to arrive at the value? Now, the value, for that matter, any asset, the value of any asset, how can we arrive at? Value of any asset, not necessary stock. Okay? Not necessary stock. There are different ways of calculating or arriving at the value. So, the widely used method of arriving any value of any asset. One way might be that what is the comparable asset? What is their value? If a building, if I say in the same location, similar type of building, what is the value market price is going on? That can be a basis for arriving the value of any asset. Or another way might be that what is the income generating capacity of that asset. Okay, income generating capacity of that asset. So, if I think that the life of the asset is 25 years and X amount of income we are expecting every year from that asset. So if you take the present value of all the incomes, present value of all the incomes, that might be the give you the value of that asset. Just a minute. Okay. So during the next 25 years, if we able to find out what is the expected income from that asset, and if we convert into the present value, okay, lastly adding all the present value of incomes, that will give you a fair estimation of that value of that asset. Okay. So the value of the financial asset is the present value of the expected cash flows. Okay. So what would be the formula? The present value equal to cash flow divided by 1 plus discounting, 1 plus R. R would be the discounting rate to the power n, the year. So R is that at what rate we will discount? Either the weighted average cost of capital or cost of equity. Okay. So this is the way of calculating the present value that we know. So that means valuation is the estimation of cash flow and capital. So the value that we are discussing, the intrinsic value, this value is called the intrinsic value, the present value of the expected cash flows. Okay. Now this process, it is a lengthy process, very lengthy process, and this process actually it involves the financial modeling, because you need to calculate the expected income from that asset. So calculating the expected earning, income from that asset, from any asset, it is not so easy. Okay. And lot of assumptions you need to take. Okay. So arriving at this value, it is the time consuming. Okay. And it requires a special type of skills for calculating that. Okay. But it is a established method. Okay, established way of doing arriving at the value. Now there is another method, the method that we are discussing, that if we see the comparable asset, okay, in the same locality, if we find that same similar type of building in the same location, okay, so what is the price of that? All those assets are going on. Based on that, we can estimate the price of our asset. This is called the relative valuation. We will focus more on the relative valuation, this part. Okay. So when we'll discuss the relative valuation, so there are 4 these metrics. Okay. What are those metrics? Now we will we will discuss discussion on all these metrics. Okay. First is the widely used, very widely used price earning multiple. Okay. How to calculate? Market price per share divided by earning per share. So if the earning multiple is say 20, that means what? That means for getting the 1 rupee earning, for getting 1 rupee earning, you need to pay 20 rupees, because 20 rupees is the price, market price. So that is the earning multiple or interpretation. So how, whether the cost, the stock is costly or it is cheaper, we can, for that purpose, we can use this metric. We'll discuss on this metric, but because only this is not the use of the PE. So how can you use all this metric, that we'll discuss. Just for understanding, just for begin the understanding, what is the PE? PB, it is the price to book value. Okay. So the numerator remains same, the market price divided by the book value per share. What is the book value? So from the asset side of the balance sheet, if we deduct the external liabilities, whatever is left, that is the book value. So in respect of the book value, what is the market price? That is also an important metric. Okay. Now, third one is the PEG ratio or price earning growth. Okay. That is a very important metric, because if PE, this is PE in a refined way. So what is the calculation? The price earning multiple divided by the growth rate. Divided by the growth rate of the company. Okay, growth rate in the profit of the company. Okay, so that is why name is the price earning growth. Okay, and lastly, it is the price per share, price to sales metric. Price divided by revenue per share. So 1 rupee of revenue for getting earning, how much price you need to pay. Okay. So these multiples specially will focus these three. Okay. Now, so if you see, the more P means the cost, the stock is more costly. Less P means the stock is less costly. Similarly, more PB means it is more costly. Less PB means it's less costly. But PEG, if it is greater than 1, better to avoid. It is better if you take the price earning PEG ratio, it is lower than 1. Okay. PEG ratio is lower than 1. It is a good one to start. Okay. That means the growth rate is more. Now, there are two important terms here. One is the book value, another is the market value. Now, if we go, just have a look. Are you able to see my screen? Are you able to see my screen?
Yes, sir.
Okay. Now, this is the screener. So all these type of these sources we should use in the class also. Now here you can see the for screening purposes, means the filtering purposes, if you want to use, or just to show the current data, this is a good point to start with. So if I say for any stock, say Reliance, Reliance Industries. Okay. So Reliance Industry, if you see, the current price is 1223. Okay, and book value is 606. Why there is so difference? Just double. Huh? Why so there is a difference between the market price and the book value? So in our, when the discussion was started, what did I say? That the book value, it is actually the what is in the balance sheet, it is showing the asset minus the external liability, that comes to the book value. That means if there is any revaluation of asset, so all this asset value and all whatever it is showing, it all are the historical values. Okay. So it is not revised, all this data. But if I see the market price is all the time, it is revised, it is revising. And one more important thing is that the expectation. Now that word carries a lot of meaning. Okay, what do you mean by the expectation? Now we will discuss on that more. We will discuss on this particular point. What do you think if I say in the valuation entire calculation, okay, in the entire valuation calculation, which element is most important? Which element is most important? Say if we go back to our this formula for this, are you able to see now the PPT?
Yes, sir.
Yes, sir.
Okay. So in the calculation of this intrinsic value calculation, what do you think that which factor is most important element in the entire valuation calculation? The whole market runs on that particular element only. Any answer? Can you expect any answer? What do you think that in entire valuation exercise, which factor is most important? Okay. So whenever we say, so what in the definition, what you have mentioned, the present value of expected cash flows, that makes a whole lot of difference. Expected cash flows. So entire valuation exercise is dependent on the expectation. What is the expectation? What is the potential of that particular company? Entire valuation exercise. You must be a great company in the past or till the current financial year. You must be the ideal company, world #1 company. Understood. But what next? What is your future plan? What is your growth potential? What is the potentiality of your sector or industry? What you can deliver in coming days or coming years? That makes the difference. So the valuation, whatever we are calculating, it all are the expectation. So also we are calculating present value of expected cash flows. So in coming years, how your cash flows will behave. There might be very challenges in the sector, in the economy. Huh? How to withstand on all those challenges. That makes the difference. So if we say that book value of a company, book value is not able to capture that expectation part. What can which price can capture this expectation? The market price can capture that expectation. So whenever you see the price is moving up and up and up, there is always a story behind it. Okay? There must be some reason behind it. Even if it is speculation, but there might be some reason, there might be some story behind it. That story might be wrong. We don't know. Might be correct. But actually, the market, it runs on the stories actually. Stories means nothing but the expectation. So since book value is not able to capture that expectation, as you have seen in case of Reliance, it is just half of the market price. That means market expects a lot from RIL. A lot. Okay? And the intrinsic value, not the speculative value. We will discuss on all this, but let's not discuss the third point now because this is very important point. We'll separately discuss. because the book value, it is the core value. There is no speculation inside the value. Okay. But market price is, it's majorly a big element, a big component of this market price is the speculation. But book value, it is only that intrinsic value, not exactly the intrinsic value, but close to intrinsic value, means the core price. Intrinsic value in the sense that not that intrinsic value what you have calculated, not that sense. The intrinsic value here, it means that it is the core value, means the whatever price we have arriving the book value, it is nothing but what the balance sheet is showing. As per the balance sheet, this is the value we are arriving at. Okay. So that is why this is the core value we can see. Okay. But no speculation in that book value. Okay. There is no expectation in that book value. All are historical values. Okay. And in market value, there is no historical value. It's all expected values. Now, now let's go back to any doubts so far? Enough of PPT. Now we'll go back to the real workings and the real market data. Any doubts so far? Huh? Can you move ahead? Just give me 1 minute. I'm just coming back. Huh? Excuse me, I have to actually, my nose is running actually. So that is why I have to go to washroom. Okay, let's come back to the discussion. Uh, so let's go back to the calculation part. So here you see this is the current year, say 24, and all are these expected values, expected years, means these future years. Now, the share, it is say 2 crore in numbers. Current market price is say 600, and we are expecting, or we are assuming that the prices remain same in all 4 years, coming years. So the market capitalization, it is 1200. Okay. Now, current year sales was 500. And Here you see the sales growth. Last year it is 20, and next year also 20%, next to next 25%, then 30% we are expecting. Now this growth, we are talking about this growth, okay, or the expectation. So these growth number are actually very vital for this valuation calculation, because the value moves on, the market moves on this expected number only. Okay, what is the expected from this company? Now, so arriving at this growth value, where from we will get 10% or 15% or 20%, whatever, where from we will get all these values? Arriving at this value, actually, it is not very easy job, because these are not, actually try to understand, these values are not the calculated numbers. So what will be the revenue projections of that company for the coming years? For that estimation, so all these are estimated values. So for all this estimation, we need to depend on the management. Okay. And for that, we need to attend the management discussion or the con call or the what is called this annual report, just to understand what is their saying, what is the management's management is saying on that expectation. So there is a source for getting these. One is the annual report, the growth and the estimation. Another source is there. You can again, I'm taking you to that screener. Okay. In the screener, you go back. See here on the home page, right side, you see the market data. Okay. And market data below that, if you see that announcement con calls. These con calls are actually very important. Okay. So it is 17th February, means yesterday only, Canara Bank. Actually, all these companies, they met the investors. Okay, big investors. So during the discussion, what they are saying, what is the management's verdict? What is the management's comment on the growth and all? So that you can see from here. So if you see, say, Sangbi Movers, view the transcript. So you will see what discussion took place. Okay. That was the Q3 financial 25 earning conference call. So here, this discussion, from this discussion, management discussion, you will be able to understand that what actually they are promising, that what will be the growth rate. So it is also a starting point, not only about the revenue growth, what is their capex plan? Okay. Is there any expansion of the business? Is there any new vertical they're going to open? So all these business plans, they are going to share in that con calls. So these reports are very vital for this information. Okay. So if you're going back to that calculation, okay. So once we get this sales growth number, okay, so then you can calculate the expected sales. Okay, you can see here, with this growth rate, we just multiplied to arrive at the expected revenue, top line. Okay. We can also get the PAT margin. What is the PAT margin? So if it is, say, we are very conservative here when you are considering. So current, what is the PAT margin? We are maintaining the same PAT margin in coming years also, 10%. So your PAT comes sales multiplied by the PAT margin. Okay, you are arriving at this PAT, this line. Okay. So PAT growth here, we are estimating PAT growth here, it is estimated 20%, means same as your revenue growth line. Okay. So whenever we are calculating all this growth, PAT growth or the sales growth, here all these important source will be the Concord analysis or the investors meeting with the company and the annual report. Okay. So these numbers are very vital and actually it drives the entire valuation. The growth estimation actually it drives the valuation. Now, PE. Okay. So how we are getting? MPS means market price per share divided by APS. So market price, say your the M cap full entire M cap or market capitalization you have taken divided by the PAT. So it gives you the P ratio. So you can do it in the per share basis, means EPS. The MPS means market price per share divided by earning per share. That way also you can do. But here we have done in absolute terms, means we didn't took it as a per share basis. The whole amount we have considered. So here you see, here also same way, P is coming 20, 16, 12. Okay. Same way you can see the calculations, the M cap divided by the PAT, that comes to the P. Okay. And PEG ratio that we have discussed, PEG ratio, it is the P ratio divided by the PAT growth. So here you can see the P24 divided by 20%, that comes to PEG ratio. Okay. PEG ratio here it is 1 or more than 1, but after that it will be lower than 1. Okay. So we have discussed already that lower than 1, it is a good point to start PEG ratio, because more than 1 means it is costly or growth rate is low. Lower than 1 means growth rate is high. Okay. Now comes to the point. Now, the P that we can see here, that P, if we observe, that P actually, there are two components in the P. Okay. Again, I am taking back to you the slide. This P actually, there are two components in the P. One is called the intrinsic P and another is called the speculative P. Okay. So intrinsic P, same way, the core P. And speculative P means that you have just now discussed, Nana, that based on the expectation from that company. Sometimes the speculation, it is expectation about the sector, expectation about the industry. So expectation from the company also. The speculative P, sometimes it goes up. So total P also moves up. But after some period of time, when the speculation died down, P again, it comes down. So there is a changes in the P. The changes in that P, it happens because of the speculative P. Okay. So when this expectation from that sector or expectation from that company is high, the speculative P will go up and up, which actually pull up the P ratio. Okay. Now, this happens, this speculation, it happens because of, so what is the result? Because of this speculation, it is going up. So when actually the P, it levels up, goes up, that means your company is becoming more valued. It is called PE re-rating. And when it is going down, just now we discussed that the speculation died down, the P also goes down. So it coming to the average. So sometimes P goes above the average. When it goes above the average, that happens because of PE re-rating. Okay. And again, when it comes down to the level of average PE, that is the PE de-rating. When the speculation comes down and the PE also falls. Okay. So this part, this component or whatever we are discussing now, this is not covered in the textbook. So if you have to discuss something very relevant, very practical in your classroom, this discussion also should come up. Okay. Otherwise, their learning or their understanding will be limited or restricted to the normal PE only, but which is not correct. Okay. Why there is a sudden up in the PE and sudden down in the PE? We'll see the trend of PE also. Okay. So actually there is a speculative PE that leads to the PE re-rating and de-rating. Okay. Now let's go back to the Excel. So now we see, so here we see that P, it is 20 and it is gradually, it is going down. Okay. Now, PEG ratio also we have calculated. Now, intrinsic P, the point that you have just discussed, intrinsic P or the core P, it is say 24. We are very conservative. Okay. We are very conservative. So let it be 24 in all the case. For the coming years also, it remains same 24. Okay. Now, what will be the target price in that case? If intrinsic, it is the your intrinsic P, if it is 24. So what will be the expected price next year? Target price. So target price will be, it is the PE, intrinsic PE multiplied by this PAT. Okay. So if we multiply it, what value we are arriving at? 1440. Okay. And since, see, the PAT is growing because there is a growth rate in your revenue line, the PAT is also growing. So because of your PAT is growing, you see next year target price increases. Next year, again, the target price increases to 2340. So if you see the how much growth you have achieved, so 17%, 33%, 49% growth you have achieved. Okay. So even if your intrinsic P, which doesn't changes very abruptly, so your target price changing. Okay. Why the target price is changing? So which factor is most crucial here, most important here? It is the growth. Because even if your P remains same, since your PAT is growing, your target price will also go up. Okay. So this is one way to arriving at the target price by avoiding that conventional approach, this your uh, intrinsic value calculation. Okay. This is another way, but here the most important or most critical element is arriving or assumption about this growth assumption. Actually, it is the growth only, it is driving the value. Okay. Now, there is another metric is called the earning yield. Earning yield means what? It is just opposite of PE. That means PE, it is price divided by earning. In case of earning, it will be EPS divided by price. So it is just opposite. So it comes, if we calculate 1 by PE, it comes 4%. Okay, 5%, 6%, 8%. Now, uh, now if we go back to the screener just to understand so we have discussed about the PE re-rating and PE de-rating. Okay, what exactly it looks like or what is exactly that? Let's have a look at the real market price. So let's go to the screener once again. Okay. So let's have a look a company, say Reliance. Here you see Reliance Industries. Let's see there is a PE re-rating or PE de-rating was there or not. Here, if you go down, you see there is a P ratios also. Okay. Now, this is the PE line, P ratio line. This is not the market price. This is the PE line. So what you can see here, this is the lines is the PE line. Now, its median PE, it is average, it is 26.4. And currently, it is at 24. That means we can say it is slightly lower than the average PE. Now, is there any abrupt change in the PE you have seen here? It is say here, PE once 2020, it was at 14. 2020, it was at only 14.4 PE. Now you see here what was the PE? 34. PE re-rating. Okay. Again, it's slightly down, 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 and it comes down to average. That means PE de-rating. From the peak, 35, it comes down to 25 close to average, 24 close to average. PE de-rating. Okay. So why there was anyone can guess why there was a complete shift from PE 14 to PE 35? Why there is a complete shift? Anyone? Any guess? The previous data, let's have a look here. It is 5 years data. So let's have a look at 10-year data. Yeah. So you will have a complex picture here of PE. Okay. Previously, it was at the level of 11, 11, 13. Then gradually it started to go up. Now here you see, actually this re-rating, it started from here. 2017, here it is 11 PE. Now here it becomes 14. Now 18, then 20, then 22, then it moves up to 35. Complete uptrend. And again it comes down to reach at its more or less average. Okay. So that is why we are discussing the importance of the stories or importance of the expectation. Now, if you go back to 2016-17, that time, Reliance predominantly, they were in petrochemical. Okay. The refinery and all. There is a complete shift in their business when they have launched the Zio. They entered into telecom and it was a super hit. great success. Later, they move on to retail. Okay. So the expectation or the stories with this uh, Jio or Reliance, actually, it is so positive. So the growth expectation from the growth assumptions from this Jio, actually it drives the whole stories. And therefore, that is the reason there was a re-rating of P. So from here, it moves, go to here, complete uptrend, you see. Now from 35, it is a downward trend, you see, now comes to the average. So it is the PE de-rating. PE de-rating. That means the speculative part. So here the speculative part, actually the speculative PE, actually it push up the total PE. Now the speculative part, as the time progresses from 2020 till the up to these 5 years, as the time progresses, that speculative piece, the speculation with this Reliance, actually it is dying down gradually. So the speculative P part comes down, which actually dragging down the P ratio, again comes to the level of the average. But from here also new stories can begin because they have merged with the Hoster. So you have to see, wait and see, there is another re-rating of Reliance or not, because there is a merger. Okay, new expectation, new stories can build up from that on. Okay, that is just an example of Reliance. If you see any other company, let's say Garden Ridge, shipbuilder. This is a shipbuilding company. Okay. The initially you have discussed now the market value and the book value. See, the book value is only 161 and market price you see 1258. Okay. Now, huge difference. So, if you look at again the P ratio, if you see the complete downtrend, it is going on. P ratio, if you see, have a look here, have a look. Again, 10 years. It is clearly visible. The PE re-rating is completely visible. From 29 PE, it moves up to 67. What a dream run. Okay. So you need to go back, find out the stories, find out what. So whenever you see there is a the re-rating of the P without any reason, without any background, this cannot happen. So there should be some reason, there should be some stories behind this rally. Okay. So might be that rally because of that some sectoral issues, the stories in that particular sector. Okay. That is called, technical terms, it is called the tailwind. Tailwind in that sector. Okay. So tailwind in that sector means there is an external support to the sector. Okay. External support in terms of, it might be the government, because they are the shipbuilding companies and repairing companies. So may be the government support, government regulations. So that is in the, that is called the tailwind in that sector, the external support to that sector. Okay. Once that tailwind die down, the speculative one die down, see again it is re-rating started. Now from 67, P had comes down to 36 only. Okay. So it is a great example of de-rating. That means that expectation, the speculation has died down completely. Comes down to the core or the intrinsic PE. Okay. So nowadays, last 3-4 months, whatever is going on, that also a big reason. Okay. So if you are a part of this market, entire market, you cannot completely neglect the entire market effect or influence. Means if you are a market participant as a company, if there is an event, there is a story or there is some speculation is going on or whatever is going on international, there you have to absorb the impact of that. Even if you are a great company, your performance is absolutely phenomenal, that doesn't matter. Okay. If the entire market, okay, is actually badly impacted, you have to also absorb that heat. Okay. So this is also a great example of the P re-rating and de-rating. Okay. So in every company, if you see, there will be some P re-rating and there will be de-rating. So the re-rating when happens, it should be backed by some news, some expectation, some that is called the tailwind in that sector, external support in that sector. Okay. Now, when the tailwind finishes or the speculative part finishes, dies down, gradually at the time passes, it also dies down. So actually it will come down to average. Now it has come to average. Now, if you nowadays, if you see all these companies, I think majority of these companies, they will be trading near that intrinsic PE only because the speculation part has completely vanished. Speculative PE is completely vanished nowadays. Only the core PE, that is only left behind. Okay? Core PE only it is left behind. So that is why all these companies, they are coming to the average PE. So this is an D rating. Okay? Now, go back to again to that, let's see, yeah. Okay. So, if this intrinsic P changes, so you have, we are assuming that it will remain same. Okay. Now, because we are conservative, we are not considering the speculative P component. Now, if you see, if you change it to say 28, what will change? If you say 28, 28, 28, huh? Make it 28, 28, 20. How much it will change? See, 56% at the end of 27, 43% growth at the end of 26, 29% at the end of 25. Now, if you see, if you slightly not very aggressive, we are very conservative, not even 24. We are expecting it is say 17%. Only 17 P, not percent, 17 is the P. In that case, what will happen? In that case, it will be a loss in case of at the end of the current year, at the end of the next year, it will be 6%, and at the end of 28%, it will be 1658. Okay? Achha. Now, there is a very important question. There might be some companies, those who are trading at PE, say very high level PE. Like say, generally you've seen 20, 24, 30, it is the PE ratios. Now, if you find that any company PE is more than 50 or near 100, 100 is the P. That company is also the people are buying. Okay, the people are buying that high valued companies, means the P is abnormal. That companies also the investors are investing. Why this is so? Because same thing, current P is 100, but if it is expectation, it is far more than that. The speculative P will be very high. So that will actually push up the price. So your coming days, your PA will be might be more than 100. Okay. So actually it will push up the target price also. So it can only happen if we expect there is a tailwind in that sector, some news in that sector, something is going on in that sector, some very positive about in that sector, or say very positive about this company, the expectation is huge from this company, it will give you that push. Okay. Now, if we go back again to that this screener, just one thing I would like to, another you need to show, you need to understand the performance of this company. So when you see that, let's see, the P goes up to the highest of this company, that is which company it was? It was the Garden Ridge Shipbuilders. So it was at its peak 86.9, 87 was the P, very high P. Okay. Here it was 46, then it moves up to 87, 86, 87. So let's try to understand what was the reason behind it. So we need to check the financial statements. So let's have a look at the income statement of that company. So if you see in that company, these are all these year performance. Let's go back to the quarterly performance, quarterly results here. Yeah, the quarterly results. So if you see, started with 487, 543, 699, 600, 700. Then it's straightway 7.756. Straightway it goes to about 900. 900 crore, more than 900, more than 1,000. It is constantly growing. When the is okay. Okay. So the point that we are discussing, when the P is going up to the level of 87, it should be some reason behind it. Okay. There should be some reason behind it. Let's have a look in their financial statement or the income statement. What is the reason behind it? Okay. Let's try to understand their profit and loss account. So if you see the profit and loss account, this is the quarterly. This is not quarter. Yeah, this is the quarterly results. So if you see the quarterly results, actually, there is a gradually move up. Okay, there is a gradual move up. So when actually did they rise up to this highest level of this P? It was June 24. It was June 24. Okay. Now, let's see what was the financial quarterly result that time. So, June 24, you see, the sales has also at the top level. The previous quarter, March 24, also their revenue also highest. It was 1,000, more than 1,000. First, only they have entered into the more than 1,000 crore sales. And the PAT, if you see, the first time they have entered into more than 100 crore profit region. Okay. So the expectation was very high during this time from this from the Garden Bridge. So it actually push up the speculative P and the total P. So therefore, it rise up to the highest level. Okay. So that is why tracking the quarterly results is very crucial. Okay. Now, because from March 24 only, they have entered into the 1,000+ crore sales for the first time. So in the coming days also, the expectation was high from this company. And here also it continues. From the March 24, continuously it is delivering more than 1,000 crore sales. Now last quarter it is 1,200 crore, first time, 1,200 crore plus sales. And profit, if you see, it is close to 198. Okay. The OPM percentage, it is this operating profit margin, it is fixed at 6%, slightly reduced. Now see here, the operating profit margin also highest here in March 24. Okay. So that means somehow the growth potentiality, although the sales is increasing, but the margin, it is slowed down this margin for last 3 quarters. That actually could not push up the sales beyond 100 crore level, but their sales is continuously increasing. So somehow it seems that this speculative P part, it is actually gradually dying down. After that only it is dying down. Okay. And the current market situation, overall entire economic situation, that also dragging down that speculative part and the total P. So it is actually comes down to the average level. Okay. So until unless there is a strong headwind, strong tailwind in the sector. Okay. That means external support from the sector, might be from the government. Things will not change automatically. Okay. Acha. So this is the importance of the PE. So it is not that PE sometimes it is costly, means we should avoid that. PE is cheap, that means always we should consider it, not that way. We have to see that way. That way, PEG ratio or PEG ratio is much more useful because it is considering growth, which is most important factor. P ratio doesn't consider that growth. Okay. And one more thing, the P that we are considering, that is the TTM. TTM means the trailing 12 month. So whatever P in that in our slide, in our Excel, the P that we are, just a minute, let me show once again. So the P, current P 24, the P that we are seeing, that is this P is called the TTM, means trailing 12 month. Okay, or the current P. But these are called the forward looking P. So the current P, it doesn't consider the growth rate. Okay, but the PEG ratio, it considers the growth. Okay. So if it is going down, that means there is a growth potentiality in that company. And that is why the big investors, they sometimes they buy high P ratio companies also. Company P ratio is very high, still they are buying because they find some growth potentiality in that company. This is the importance of the growth. Okay. Or the P ratio or the PEG ratio. Now, let's show you another source where we can find that I want to know that what are the low P ratio companies, what are the low PEG ratio companies, or what are the high P ratio companies. Okay, let's have a look. I want to see. So how to do that? So I'm sharing you another source. So any type of screening, any kind of website or applications where you can filter your output. So this is another source where you can filter your output. So this is the analytics. So from the analytics, you go to scans. Okay. In the scan, if you see the fundamental scan, okay. In fundamental scan, we are interested in the valuation scan. So click on the valuation scan. Okay. Now see the very high P ratio 22, very high means 50 plus P. High P means 20 to 50. Moderate means 10 to 20. And low means 0 to 10. So let's have a look. What are those low P ratio companies? There are 42 companies are here. As of today, as of yesterday, these are the low P ratio companies. Okay. Let's have a look this Hindalco. Okay. Now Hindalco, if you see, this is the P ratio line. You can see TTM PE means trailing 12-month P means the current PE. These are the. So this is the latest P which is 9.88. Okay. Okay. Now, if you see the P at the beginning, or if we talk about last 2 years, February, March 23, that time P was only 8 rupees. Okay. It was going on average, the point we are discussing. But here you see there is a jump in the P. From the 8 rupees in the average, it moves up to 11 rupees. So we can say this is a P re-rating. It happens on August 23. Okay. Again, it is going on average. Again, you see there is a re-rating. It happens on January 24. P become 15. Now, after that, you see suddenly there is a huge drop in the P and it become on the next month only and it become 12 rupees from 15 plus it comes to 12 rupees. From 12 rupees again that gradually goes up, go to that level. Again it is dying down. It is a de-rating and it again come back to the original point. So it close to average. Comes to close to average. Okay. Now, what might be the reason? Let's go to the Hindalco in the screener. Let's have a look. What is the performance? Hindalco Industries. Go down. This is the P ratio. Just have a look. So P ratio just now we have seen it was 38. It was 1 point, it was 38. That was in 2020. Slag, now it is dying down. It comes to 5.6 only. From 5.56 only it started to rises, then again it is dying down. Now it is only 9.4, close to average. There is a huge de-rating of the P ratio. Okay. So if you find that what was the performance, quarterly results, so that give you some hint. Okay, quarterly results, if you see, sales, it is 55 crore, 1,000 crore plus is going on, 53, 55, 54, September 23, 52, and profit also it was June 22, it was the all-time high. It was last 10-year high. It was 4119. So June 22. So let's see June 22. Where was the P? June 22. June 22 actually, it was P was by that time the P is already derated. By the time when the actually the result delivered, by the time the P is already reduced. Okay. Now, from here, it started gradually to increase. Now, after that, what was the performance?
sir.
Yeah.
I think screen, it got stuck with Hindalco Industries. Analytics you are showing, no? There only
Acha,
that,
acha, acha, acha. I
that
have to
screen
change it
is.
now. Okay, okay,
Yeah,
just
yeah.
a minute, just a minute. Yeah. Yeah, now are you able to see?
Yes, sir.
Yeah. Some background noises there, please mute yourself. Please mute yourself. Background noise is there, na? Okay. So the point we are discussing, see, the quarterly results of the this Hindalco, if you see, the PAT that we can see here, it was highest in June 22. That time PAT was more than 4,000 crore. Okay. So after that, if you see, there is a dying down, there is a company goes down, this PAT level especially goes down, and it never goes back to the June 22 level. Okay. The revenue, because this revenue line also, if you see, it was highest in June 22. After that, it never crosses the June 22 level. Now it has slightly reached to that level. December, the current quarter, the last quarter, that is June 24 quarter, it has able to cross that June 22 level. And PAT, if you see, a PAT, but still it is lower side. Okay. Overall, the performance there is a steady growth in the performance. We are not able to see. There is a PAT level has increased, or sometime it is going decrease. So it is a volatile type of. What we require actually the consistent growth in the top line as well as the bottom line. That is the revenue line and the profit line, PAT line. Okay. That somehow it is not, we are not able to see here. Okay. So the PE also, therefore the PE also, it fluctuates heavily. Okay. So June 22, after that, when that company delivered the highest ever the PAT or the revenue line, after that there is a gradual increase, okay, till Jan 24. But after that, the gradual decrease we have seen, we can see. So it is because the performance also, it is very unstable performance, quarterly performance or annual performance. If you see annual performance, if you see, let's have a look the annual performance. If you see the annual performance, the bottom line, you see there is a huge growth in March 22, the point that we are repeatedly were discussing. But after that is drying down. This trailing 12 month, this is trailing 12-month result. But last March 24 result, if you see, it is 10,155 only. Might be this financial year they will be able to cross that last year PAT. But the performance, it is very unstable. You see the 23 March 23, it is reduced to 10,000 crore. After the March 24 also it was the same level. So the performance, it is not actually very encouraging or stable growth we are not able to see. So therefore also after the March 24, this where we have seen this, actually it is dying down. The performance, this speculative P part is actually dying down. It is comes to the core P or that intrinsic P, which is at the median, it is 12. It is more, less than the average, P. Okay, it is currently it is only 9.4. Okay. So if we go back to that our application where we have filtered it, okay, We have filtered it. Okay. So let's go back to that filter. Now, this way you can high P ratio, low P ratio, the company, say moderate P, if you see. Now go back to the last time you have seen this high, very high P ratio. What are those companies? P is 50 plus. So what are those companies? Westlife Foodwell, Delivery, FSN e-commerce. Let's have a look at the delivery. Okay. Let's have a look at the delivery companies. Now, okay. Now, delivery companies, Delivery Limited. Let's see in the screener also. Okay. Now see. It is very new company. Just it is the IPO was launched. So 1 year data only will get it. 3 year, 5 year data will not get it. So it is too early to comment. But the performance, if you see, quarterly results, if you see, there is a growth we can see from December 23. December 23, there is a growth we can see. Before that, it was below 2,000 crore level. From December 23, we are able to see some growth. And from December 23, they are able to enter into the profit region. Before that, it was a loss. Okay. Now, March 24, again, it was a loss. But after that, there is a consistent profit we can see. 54 crore, 10 crore, then 25 crore profit last 3 quarters they have delivered. So, but nowadays, what happens here, you see that top, the P is slightly dying down. The speculative P is dying down. So it was at the level of, please, mute yourself. Mute yourself.
Venkataraja sir.
Okay. So you see here, since the data is not available, okay, because it is a very new company, so we cannot make any comment.
Hello sir, am I audible? Hello.
Oh, yes, ma'am. Sorry, I was muted.
Yeah.
If you see the delivery, since it is a newly launched company, just last year only that IPO came, so we don't have that much of data. But if you see the P line, so P, it was at the top, it was 929. Okay. It is very rare companies, those who are having P at such a high level. Okay. And the now P has come down to 486. So there is a serious de-rating in the company. Okay. P de-rating of the company. Now, if you see the P, so still when the company started, it was P was 786. Still, it is very high, very, very high, abnormally high. But if you see in that company also, the investor has invested. The point I'm trying to say that in this highly expensive stock also the investor, they invested. Okay, what is the reason behind it? So if you see the November 24, the P, November 24, if you see the November 24 results, December 24 result rather, December 24 means it is just these only. They have after two consecutive quarterly profit. This was the third one. Okay, third. So since the actually it is very newly launched, we don't have that much of data also. So that is why we are not in a position to make any comment on this. Because all this data that you can see for last 4 years, this time the company was actually not uh, listed. The company got listed from December 23 for 24 only. So therefore, but the point I'm trying to make it here that when the P was 700 plus, close to 800, that time also the investor investing in the stock. Why? Because of the growth potentiality in the delivery company. And the business model of the delivery company, it is quite impressive. It was quite impressive. It was quite impressive. Therefore, the investors still continue to invest in that company. But we have seen last 2 months there is a serious de-rating in that company. So this de-rating actually it is dragging down to the core level or the intrinsic P level because now though the speculative part is completely died down. That is why it happened. So that is the one extreme example we have shown. Now, if you go back again to that filtering part. So now what you need to do, if you are an investor, what you need to do. So in that case, if you look at some scan that is called the combo scan, uh, the combination scan, in the combination scan, I have made a combination of like this way. The low P ratio companies I know I want, the low P ratio companies I want, low P ratio means 0 to 10 I want, and with the high level of financial performance. So that is why you see quarterly net profit growth year to year on year I want. Consistent growth in the quarterly net profit and year on year increase in the quarterly sales also I want. That is the most crucial point. So if you scan with this four filter, we are getting this much of companies. Bank of India, Bank of Maharashtra, GAIL, Hindalco, Indian Bank, Karur Vysya Bank, Power Finance Corporation. So just have a look at the Power Finance Corporation. So from here, you need to check that which company actually you need to go for. So if you see the technicals, the chart, if you see the Power Finance Corporation, PFC, okay, the if you add the PE also as a chart, in a chart, if you want to see the PE also, say I want to check the TTMP, okay, save. Now have a look. So here you see Power Finance Corporation, there was a, this is de-rating. Now there is a serious de-rating. Okay. Now it is going on an average. It had come down to the average level. Okay. And if you see this growth, so since here you see there is a P re-rating is happening. Okay. And here also you find that there is a growth. But after that, there is a gradual decrease because last 3 months, the same impact the Power Finance Corporation also cannot neglect, cannot avoid this impact. So there is a not serious derating, but it is coming down to the average level. But here there is a serious derating happens. After this re-rating, there is a serious derating happened here. Okay. If you see that that is the way I'm showing you that so these companies, it has a performance, it is a constantly delivering the net profit growth and the quarterly profit growth, and these are the cheap companies also because the PE ratio, it is very low level. So from this company, these are the results it is given to you. Okay. Almost how many companies are there? It is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 companies names are given. Okay. Now, out of these companies, that it is your job to select this company. If you are happy with any kind of storyline with any company or the growth potentiality of this company, then you can gradually enter into that company. Okay. So this is a way to start. Another way, this is the last filter that I'm trying to show. That is a fundamentally strong companies. Who are these fundamentally strong companies? So what are these? How to identify it? What are these fundamentally strong company? So these are the 6 scans we have used. What are those scans? These are the fundamentally sign of fundamentally strong company. Consistently high EBITDA means earning before interest, depreciation, and amortization margin. Consistently high PAT margin. High return on capital employed. High ROE consistently. Consistently positive cash flows. Free cash flow. Free cash flow consistently positive means cash profit. Although you are having net profit, but doesn't mean that you are having cash profit also. But cash profit is more important than net profit. So this filter also you have used. So and obviously the stock has to consistently outperform the index for last 3 months. So if we apply this stock, this scan, let's see how many stock is coming under that. No stock is absolutely matching this filter, but closely these companies are matching it. Britannia, Castrol, Dabur, Godfrey, Nestle, Procter and Gamble, all these companies, they had, no, these companies are perfect match. These companies, we can go ahead with these companies because these companies are strong enough, good momentum in the sense that they are at a growing, at a steady pace, they are are able to outperform the index as well as fundamentally also they are strong. So this is a good point to start, like the Castrol, okay, like the Dabur, okay, like Godfrey Fimis, Nestle, Procter and Gamble, all these companies, it is a good point to start because these are the fundamentally strong company. At this point, what is most important, this time is very vulnerable is going on. So at this time, what is most important, that fundamentally strong company, those who are fundamentally weak, they will not be able to withstand with this kind of challenges. Only the strong companies can able to withstand with this type of challenges. Okay. So this is a good point to start with if you want to invest in a fundamentally strong company. And what do you mean by the fundamentally strong? This is the scan we have used. The 2 type of scan I have shown you. This scan we have used to start with the fundamentally strong companies. Okay. So we have a running short of time. There is another resource person with us. So any doubts so far? We have to stop it here. So any doubts so far? Sorry for the technical glitch and the breakout for the 2 times it happened.